Welcome everybody. My name is Bob Klefsis, President of All Star Financial. I want to welcome you to our third quarter 2013 webinar. As you can see, we've in the past done an audio with PowerPoint. We actually have a video here with you. I'm going to talk about our title to our newsletter this quarter is Markets Zig and They Zag, but without real economic justification in a second. But first I want to welcome the newest member to our team. Josiah Larson has been with us for a couple of months. Josiah comes to us after graduating from the University of Minnesota and working 5 years at the United Health Group in the finance and marketing side. He and his wife Lauren live in Minneapolis, and Lauren works for Target, so you may know her. I also want to remind everybody that year-end tax planning is really important right now. That's why we have CPA Beth Johnson on staff. She's going to talk to you about your estimated payments, whether withholding should be changed, should we pay our state taxes before so we can deduct them on our federal, and check on all those gains, and maybe have to have some more payments to go in because of extra gains in the market. So again, after the fact, it's just tax preparation. We'll be in touch with you if you're clients of ours. If you're not, get a hold of us and we can let you know what needs to happen. So again, market overview. We think the title, Market Zig and They Zag, is appropriate. The global economy overall is very, very positive. When you look at Europe, Japan's positive with new leadership and the weaker yen. China and their new leadership with their new prime minister and more stimulus promises. Housing and business, manufacturing and energy has been up in the U.S., but the U.S. still has a weaker than what we would like business and consumer spending. And I think that is going to come back to potentially hurt us. As a result, the Fed has to continue to ease, keep that $85 billion a month going. Policymakers are being hung up in Washington over the budget and the debt ceiling, as we've talked about, and again, now a government shutdown as we're living today. Continued slow improvement on the U.S. side economically speaking. Second quarter GDP was up 2.5%. We estimate the third quarter to be about the same. That comes out in a couple weeks. Inflation is still low at 1.8%, so that's a real positive. We're seeing growth in payroll of 160,000 new jobs a month, which is real positive. Housing, manufacturing, and energy is all positive. But again, the big question is business going to be able to spend? They're really hoarding cash. In 2009, they had about $1 trillion in their corporate coffers. Today, corporations have more than $2 trillion. So again, we have to get them off the dime and starting to spend. The other issue that's a concern is in Washington is the Affordable Care Act and all the uncertainties that come out of that too. Right now we're at about 25% below where we should be to be self-sustaining from a payroll standpoint. So again, looking for that to change as we go. So a title can't really change from last quarter. Slow and cautious growth despite U.S. earnings at record levels. The uncertainties, I think, outweigh this positive though. When you look at the government shutdown and the fear of the budget and the debt ceiling there. Can Washington come to the middle, I think, is a big question. How will people receive the replacement to Ben Bernanke, perception-wise, business-wise? And are the businesses going to start to hire and spend, and in turn consumer spending go up? The one thing that we are a little bit afraid of is we've seen for the last 3 quarters that consumer debt has increased, so people are spending more than they're making. Something that's not a practice that we want to see long term. When we look at the bond market, and we basically talked about last time that this taper tantrum was really overdone. The yield spiked up in the second quarter all the way up to 3%. 10-year rates dropped from 3% to 2.6% in the third quarter. As a result, all bonds were up. When interest rates go down, bonds go up. Europe was up almost 3.8%. Corporate high yield bonds at about 2.3%, emerging bonds 1.2%. Barclays aggregate in the U.S. was 0.57, and then the government in the U.S. was slightly positive at 0.12. Looking forward, again, we're looking at the overreaction has corrected itself as we had predicted. That 10-year Treasury is down from 3 to 2.6. We believe it can come down further if the scenario with the economy starts to slow down, and interest rates will have to stay low. But as a result, we think all bonds will be positive. We still play, and we still believe that they play an important role in your overall composition of your portfolio, albeit a little bit less. But bonds are that stabilizing risk reduction when rates rise type of part of your portfolio. When will rates rise is really the big question. We don't know, so we've made a few changes in your bond portfolio. We've added the PIMCO low duration, the Pioneer floating rate, and the double line emerging fixed income to really help minimize the volatility either way markets interest rates rise or they go down. When we look at the domestic stock side of the world, again, solid gains, but the gains are coming up to the top of where their valuations we believe can be. We've gone from 2009 to now, a 4.5-year bull ride, and the indices have gone up drastically. Russell 3000 this last quarter was up about 6.35%. That's a broad market index that we like to use. The small caps outpaced the large caps about 10% to 6%. Growth outpaced value for the first time. Value outpaced growth for the previous 3 quarters. So growth was a good indication of positive things. And all sectors were positive except for telecom. All of the 10 main sectors, that was the only one that was not positive. But we still have a lot of uncertainties, and that's really the big question in whether we can get by with what Congress isn't doing right now. Corporate earnings are solid, markets fairly valued, but a bit rich, as we talked about. Looking forward, increased dividends has helped people to stay committed to their stocks. Repurchasing of stocks has created a value for corporations and equities like that. Acquisitions, people like that. We've got a lot of companies being purchased today. But again, the uncertainties that Washington bring us in the business and consumer spending and the Fed chairman and all of those things creates the uncertainties that we're afraid of. On the foreign side of the equation, however, we really got back on track there. We lagged in recent quarters, but the tide's turning. And if you look at the performances this quarter, it's a good example. Europe was up over 13.5%. EFI, which is Europe, Asia, and Far East, was up about 11.6. The Japan and China, which are in the emerging countries of more of those Far East, 6.7 and 5.8%, and China up over 12%. Looking forward, we still believe that they are a good buy. And we look at valuations that are better than the U.S. We look at the central banks overseas have a lot more room to basically ease interest rates than we do here in the U.S. So we think that that's a real positive. Well, what we've done is we've shifted some exposure from passive managers and ETFs to more active managers because we feel in this top of the market volatility, active managers are going to outperform. We've gone some internationally from large to more small because we feel that that's going to take off finally. And in summary, markets will continue to zig and zag because of all of our uncertainties and the Washington gridlock and the U.S. Earnings, are good, but we need corporations to start spending on the hiring to make them better. Global valuations are good, but will the U.S. Uncertainties dampen them? We're into 4.5 years into a recovery. The big question is really, can it sustain itself? And I think in the next 2 months we're going to have a lot better indication there. On our last page, second to last page of our newsletter, we want to talk about the Affordable Care Act and you. And what you need to know, obviously being very, very important for everybody, all individuals are required to have health insurance, or they'll pay a penalty. But you can't be denied coverage. So there's always going to be somebody there that's going to be able to cover you. There's 4 types on the macro view. There's bronze, silver, gold, and platinum, 60, 70, 80, and 90% payment, which is good to know. You can basically buy at what level you feel comfortable. MNsure is a great one-stop location for Minnesotans, small business health options, or they have a shop for that too. And if you're already covered, it's really no big change for you. Medicare recipients, no change at all. Anybody over 65, it really doesn't affect you. Our last page, the Just for Fun that we added a couple quarters ago with our new newsletter format, we always like to throw in a restaurant recommendation. I was just at Broder's Pasta Bar in Richfield on 50th and Penn. Loved getting out of the car and the smell of the garlic and all of the great dishes that they put together. I'm also going to brag on my mom's apple pie. We're going to have a recipe there for you that is just fantastic. And we always like to go and give a quote of the quarter. And Josiah Larson, being our newest member, we asked him to come up with his favorite quote, is leadership is doing what is right when no one is watching. And George Van Valkenburg. Want to thank everybody for their continued trust in the All-Star team. And remember, again, our referral program. You guys are our lifeblood. Give us a call at any time. Again, we appreciate your trust in All-Star Financial. For those people that are not clients, give us a call and we would be happy to do a free financial plan for you.